To part 2 of the video lecture for chapter 8, accounting for long-term assets. So in this video, I will complete our discussion of long-term assets. I have to finish the topic of depreciation, talk about additional expenditures and the disposals of plant assets. I will briefly mention natural resources, intangible assets, and the total asset turnover. So in the first part of the video, I talked about computing cost when we acquire a long-term asset, and we described three depreciation methods: the straight line depreciation, the units of production depreciation, and the double declining balance. So there are a couple of extensions of the topic of depreciation. One of them is a partial year depreciation because so far we always said, we acquired the asset on January 1st. What if we bought it in the middle of the year? So right here, assume our machinery was purchased on October 8th. The general rule is that anything up to the 15th of the month, we are going to count that whole month. So if the asset is acquired by the 15th of the month, that whole month is counted. If it's acquired after the 15th of the month, we will ignore that month. So here we're going to calculate the annual depreciation, which is cost minus salvage value divided by 5 years. And then we're going to apply how many months we actually had it in 2021. So if I bought it on October 8th, I will count in October, November, December, which is 3 out of 12 months. So the first year partial depreciation is $450. Okay, the second topic here, what if I make changes in my estimates? I can change either or both the salvage value and the useful life after, sometimes in the middle of the life of the asset. So new information may come to light that indicates that the original estimates were inaccurate. So how do I recalculate depreciation? Here's an example. We use straight line depreciation for a car with this cost and salvage value and an estimated useful life of 4 years. After 2 years, at the beginning of the third year, Apex determined that the car has a total of 5 years useful life instead of 4 years, and it will have a salvage value now of $2,000, not $2,400. So I have to recalculate updated depreciation for years 3, 4, and 5. So it's easy to get confused here. This is a good formula to remember. So we have to take the book value of the asset at the time of the change minus revised salvage value divided by revised remaining useful life. So let's look here at the example we have. So first of all, let's calculate the book value. If it's not given, we have to do calculations. So what was depreciation for the first 2 years? So the annual depreciation was $23,860 minus $2,400 divided by original 4 years. So that was annual depreciation, and I depreciated it for 2 years, right? We're going to make a change at the beginning of the third year. So I multiply it by 2 years. So this 10,730 is my accumulated depreciation after 2 years. I need to know the book value. What is the book value right here at the time of change? And the book value would be my original cost, 23,860, minus 2-year depreciation of 10,730. So this 13,130 is the book value. So I'm going to plug it in right here. 13,130. Let me double check. What is the revised salvage value? The revised salvage value is $2,000. And what's the remaining useful life? So I already used the car for 2 years. We determined the total life will be 5 years minus the 2 years used. So it will be 3 years right here remaining useful life. And right here, my new salvage value is $2,000. So we calculate this, and that would be the answer. So $13,130 minus $2,000 equals to $11,130 divided by 3 years. So every year for year 3, 4, and 5, this would be amount of my depreciation expense, 3,710. You can practice more. I'm not going to go into this quick study, but please practice more here. Just plug into this formula. Okay, the next topic is a topic of what happens if we need to make certain additional expenditures to our existing asset. So we will distinguish between revenue expenditures and capital expenditures. So a revenue expenditure is going to be completely expensed right away. We're going to debit some kind of expense, and these revenue expenditures are called ordinary repairs. So we need to maintain normal operating conditions. It doesn't significantly increase productivity. It doesn't extend the life of the asset beyond the original estimate. So if you think about a car, if we are going to do any kind of ordinary repairs, if we're going to change oil, that's not going to change the original cost of your asset, of the car. We will simply expense that entire amount. So it's called the revenue expenditure because it goes on the income statement and expensed out. We're going to debit the expense account. If you change tires, we have to be very conservative here. You can say, well, putting new tires on the car is going to extend its life, but we have to be conservative here. And changing tires is also just our ordinary repair. Capital expenditures is something significant, is something that is going to increase my productivity, increase the amount of revenues that asset is earning for us. And it happens rarely. It's some kind of major overhaul or partial replacement. And so if, for example, we're going to put a new engine in the car and we spend $10,000, I'm not going to expense right away. That $10,000 will be debited into the car. It will be debited into the balance sheet account. So here's a couple of examples. We pay $300 for a tune-up of a delivery truck, and this is just an ordinary repair. You can see I'm debiting the expense account. It's called revenue expenditure. But if I added 5,500 hydraulic lift, which allows for increased efficiency, more revenues to be made, this $5,500 is a capital expenditure, and it doesn't go into the expense account, it goes on the balance sheet. It increases the original cost of the delivery truck. Same right here with the engine for the forklift. You can see it's a debit to the balance sheet account. Okay, now we're done using our long-term assets. How do we record their disposal? We can discard, sell, or exchange the asset at the end of life. And guys, typical 3 methods of asset disposals are right here. I can sell it for cash, most common method. I can retire it. It's no longer useful. I cannot sell it. I sometimes have to pay cash for it to be hauled away. Or I can exchange it, right? When you trade in your old car, you're exchanging one asset for another. And sometimes you make additional cash payments. So the journal entries could get a little complicated here. Here is data. This is the cost of the truck. This is its salvage value, residual value, $5,000. This is its life. This is assumed straight line depreciation. So right away, guys, if I used it for 5 years, and straight line depreciation here is $7,000. Okay. There are 4 different scenarios right here. What if I sell the truck after 3 years for $22,000? What if I sell it after 3 years for $17,000? What if I retire it? I cannot sell it. And what if I exchange it for a new truck with the cost of $45,000 and $22,000 additional payment? So I trade in my old truck. So I want you to pay attention to these 4 steps. These are the 4 steps I'm going to walk you through. So first step, I'm going to take off my books the asset. So to zero out the asset, I am going to credit the asset, the truck, by its balance to make it zero. Then I will zero out its corresponding accumulated depreciation account. So whatever my accumulated depreciation is, I'm going to debit it to make it zero. So right away, guys, right here, let me go right here. If I'm going to sell this truck after 3 years and every year depreciation is $7,000, then after 3 years, the accumulated depreciation will be $21,700. It's just 7,000 multiplied by 3 years. Okay? And then step 3, look at cash, if cash is involved. If you are selling the truck, you debit the cash account. If you have to pay cash, you credit the cash account. And the last step, plug in is what's missing. If you're missing a debit amount, you have a loss on the disposal of the asset. If you're missing a credit amount, you have a gain on the asset's disposal. So let's go through 4 examples. So the first example, we're going to sell truck after 3 years for $22,000. So guys, I'm going to follow 4 steps. First step, take off the truck. The truck was worth $40,000. Credit it. So it offsets the original debit balance, makes it zero. Second step, debit zero out accumulated depreciation, makes it zero. Third step, we're setting it for cash $22,000 right here. And guys, the last step, what am I missing? 22 plus 21 is 43, so I'm missing 3,000 credit. That's a gain. Or another way to think about it, look at the book value. So your truck is 40,000 minus 21,000 equals to $19,000. So you believe on your books your truck is worth $19,000. But how much were you able to sell it for? 22. So you sold it for a gain, for a higher amount of $3,000. Guys, a different scenario here. Everything is the same, but now cash is 17,000. Again, what's the book value? 19, but how much were you able to get in cash? 17. So you have a loss because you're missing a debit amount. It's a loss. And here is a retirement where there is no cash. So the equipment was $40,000 original cost. The accumulated depreciation is 21. You're not able to sell it, so there's no cash. There's no cash account. You're not getting any cash, so your loss is $19,000. And the last one is gain on exchange, and here it gets a little complicated. I don't think I will be asking you this question, but you can look at it where you acquire new equipment, new truck, you are adding cash, and then you're missing here a credited amount, which means you have a gain. Okay, we're done with the planned assets of PPE. Let's move to natural resources, right? So natural resources are extracted from the natural environment and reported at cost less accumulated. Depletion, these are examples. So instead of the word depreciation, we're going to use the word depletion here. Guys, the way we're going to calculate depletion is the same as units of production. So every time I extract 1 ton of ore, my mine is depleted by how much? What's the depletion per unit? Cost minus salvage value divided by total units of capacity. So depletion per unit is $2. And then how many units did you extract at the end of the year? So here we extracted 85,000 tons multiplied by $2, 170,000. You debit depletion expense, you credit accumulated depletion. That's it. We're not going to talk much about natural resources. Okay, account for intangible assets. This is a large group of assets that do not have physical substance. They have to be identifiable, separable from the company. So for example, if Walmart, of course it has a brand name, Walmart, but it's not separable from the company, so it will not be listed on the company's balance sheet. We usually acquire them for operational use, and their useful life is often difficult to determine, and the salvage value is usually zero. So some of the intangibles have finite lives, such as copyrights and or your franchising agreement, your leasing agreement has a specific life established by the contract. So if they have finite life, we will amortize them. So instead of the word depreciation, we will use the word amortization. If the intangibles have indefinite lives, such as for example Goodwill, we will not amortize them, but we will check them annually for any loss of value. And if there is any loss in value called impairment, we will have to journalize this. Again, this is probably going a little bit beyond of the focus of this course. You will study this group of assets in more detail in higher level courses. So I will go fairly quickly here. Uh, so these are different examples of intangibles, right? Intangibles, I divided them into this 1, 2, 3, 4, 5, 6 different groups. So you have marketing related, these are examples, customer related, artistic related, contract related, technology related. And guys, goodwill is what we pay for acquiring another company above its net worth. So if, for example, Amazon purchased Whole Foods, and I'm making up the numbers, and on the balance sheet of Whole Foods, if you take their assets minus liabilities, so their equity, their net worth is $2 billion, but Amazon paid $5 billion. The difference, $3 billion, we have to record somewhere. So we debit this new account called Goodwill. So don't get confused, has nothing to do with the donations. It's a amount we overpaid by acquiring another company. So here's an example of the patent, right? So what is the patent? It's a right granted to the owner to manufacture and sell an item for 20 years. So within 20 years, we will amortize the patent. After the patent expires, the salvage value is zero, you cannot resell it. So Matrix purchased the patent for $10,000. The patent is expected to have the useful life of 10 years. So you take 10,000, divide by 10 years. Every year, what do? You amortize, you record the amortization expense, $1,000, and you credit accumulated amortization, $1,000. So this is a definition of copyrights, which also the right to publish and sell any kind of creative work during the life of the creator plus 70 years. You can look up why it's called the Mickey Mouse Law. That's an interesting story there. Leaseholds, also there's a contract of, we are actually leasing a building, and so that's the asset that will be coming in for the next 5 years or 7 years or 10 years. Leasehold improvements, franchises, licenses, trademarks, and so on and so forth. And then I talked about the goodwill and what that is. And guys, goodwill is not amortized because it doesn't have, its life is indefinite. But every year we test it to determine if the value has been decreased, impaired. If the value of goodwill went up, we don't do anything. But if the value went down, we have to make an adjusting entry. But you will not be required to do so in this course. Okay, and then this chapter concludes with this total asset turnover ratio, which is net sales divided by average total assets. By the average total assets, I mean the total assets of this year plus previous year divided by 2. Pretty much it tells you how much sales does every dollar of total assets generate. Why do we buy assets? To generate sales, right? So that's our investment. We're purchasing assets, we invest money, and then the higher my total asset turnover is, the more efficient the company is in generating revenues. So the higher asset turnover represents usually a better company. So you can see here Molson Coors and Boston Beer, and you can see that Boston Beer generates more revenues per dollar of asset. This concludes chapter 8. Thank you so much.